Hello and welcome once again to the Smart Money, Dumb Money Show. I'm your host as usual, Keith Richards, and I'm President and Chief Portfolio Manager of ValueTrend Wealth Management. And today we are going to talk about the TSX and why I like the TSX right now better from a technical point of view, from a charting point of view, than the S&P 500. So it's Canada versus the US, and right now I think that the Canadian stock market actually looks a little better. And we'll take a look at why I feel that way from a technical perspective. So let's get at it. What I'm showing you here to start off with is the US index, the S&P 500. And that's kind of the benchmark. It has its faults, as does the TSX 300, by the way. But the major fault, I think, is that these are capitalized weighted indexes, and they will tend to exaggerate the movement of their markets, whether it's the S&P 500 or the TSX 300, because of the capitalized weighting. If you get one sector, such as with the S&P 500, we've had the technology sector do a lot of the lifting over the past few years. It kind of distorts the view about what the whole market's doing. So you can look at equal weight indexes, but we're going to just look at the standard index that most people pay attention to, which is the cap-weighted S&P 500. What I want to show you here is that we had a high back in the summer. As you can see, it was around, I guess it was around June, and it hit around 56.70 or so. And it basically matched that high fairly recently in the fall, and then declined a bit. As you remember, early September, we saw a sell-off, but then a very, very quick recovery. That's what these two bars here look like. In fact, if I were to show you the daily chart, which I can, in a matter of seconds, I'll look at, say, 6 months worth. There you can see there's the two highs. They were pretty close, 56.50, 56.70. We're going to call them pretty much break even. And then we got the breakout. So if we use a crosshairs tool, we can see there's the breakout. A little bit of a gap in there. And now the S&P is returning to that approximate breakout point. Okay, all is good so far. But I'm showing you all this stuff, and I'll go back to the weekly charts and pick out a few years, 5 years, okay? Because I want to compare this to the Canadian market. I want to just first show you that because of the weaker high, we did get a breakout. There's the breakout, and it's rounding over a little bit, but it really wasn't a massive breakout, was it? It was just kind of a gentle breakout. And because of that, we have been seeing really over the past, say, 8 months or so, a bit of a divergence in money flow momentum. You can see some money isn't piling into the S&P 500 the way it used to be. It's still going in, don't get me wrong. You can look at the volume charts and they're higher here, but it's been generally decreasing. And the way this measures things is it looks at positive days versus negative days and looks at the volume on the positive days and compares it to the negative days and then applies an RSI to that. So really what we're seeing is truly money kind of becoming less interested in the S&P 500. And this is also showing in price momentum. So this is just pure price, whether the price is going up or down, and how's the momentum on it going up. Well, you can see the MACD was moving up nicely in through 23, early 24, but that has begun, I should say, to diverge negatively. Same with RSI. You can see a bit of negative divergence lately. It's not making higher highs and higher lows. It's actually going down, even though the S&P has gone up and made new highs. So this is often a warning sign. It doesn't necessarily mean, you know, the end of the world, but it could mean that we will be stuck in kind of Groundhog Day, as that Bill Murray movie went, where it's kind of much ado about nothing for a while before the market decides to really catch a breath. All right. And if you read my latest barometer report, which was put out in the first couple of days of October, I think it was, I put it out on the 2nd of October. The barometer report talks about volatility, and I look at the trend of the VIX in it. I'd encourage you to look at that report, and you'll see that my prognosis is with the VIX rising as a trend, that means that volatility is rising. So you may see, all the stuff we're putting together on the S&P 500, some kind of chop that is going to be less favorable to the buy and hold investor. Anyways, that's it for the S&P. It is moving up, but it's losing steam. That's the conclusion. Now let's take a look at the TSX, which is the S&P TSX 300, right? Much different look, isn't it? I mean, first of all, we had two higher highs during the same period that the S&P experienced no higher highs. And then the breakout has been pretty good. It's been pretty significant. So it's maybe a bit overbought. And if we get back down here, we can see money flow moving up. All right. MACD moving up, a higher high on the MACD. Everything looks good. Maybe it's a bit overbought. The RSI shows it's a tiny bit overbought, but none of those momentum indicators are diverging negatively in the way the S&P 500 is. Clearly, the trend is up, higher highs, higher lows. No stopping this index. It's probably overbought. It's probably due to a pullback. And you guys know why it's been moving up. It's because suddenly the materials and the energy and commodities have caught a bid. And we have a good chunk of that stuff in the TSX. Guys, what have I been pounding into your cranial vaults for the past year or so? This is going to be a commodities market for the next number of years. Yes, I know all about the NVIDIA story, but that's really just one thing. And it got so overvalued. And meanwhile, everybody was overlooking the commodity space. So it's not been so much the oils lately, but it has been definitely the materials and the industrials. So, or the materials, I should say, and the metals. So let's take a look, because FYI, the TSX composite is 28% financials, 14% energy, and 14% materials. So that's 28% in the major commodities and 28% in financials. And then the next largest group is industrials, which is about 12% of the index. This all adds up to 70%. So you've got four sectors that represent 70% of the index. Sounds a little bit like the S&P 500, right? Except it is spread over four, not just the technology sector, which took up 35% or something like that of the S&P. You do have some diversity amongst the sectors, but really, I would even say that there's three sectors that dominate the S&P TSX, and that is financials at 28%, and generally speaking, commodities between energy and materials also at around 28%. And that's 2024 weightings taken about a month ago. They change by 1% or so every month. So let's take a look at those charts. First, we're going to look at energy. Now, energy has been, and I'll turn on my crosshairs tool here, energy has been in the doldrums since really the beginning of the year. And you can see, like, momentum fell a lot. It's maybe starting to recover, but it's been pretty low. Like, momentum had been trending down, nothing too exciting about energy. That's because even though it's not a downtrend so much, maybe you could argue it's a small downtrend, but it's certainly not been very exciting. If we take a look at a shorter term chart, you can see that it's really just been not quite sideways, but a very slow drop down, making lower highs and lower lows. Okay, so back to the 5-year charts again, we can see that there is some support coming in on energy, and there's been stuff going on in the world like wars and even China's stimulus that ultimately is probably bullish to energy, although it doesn't seem like it's turning around just yet. So that's held our index back, and it is 14% of the TSX. What's interesting is that if you read my reports on energy, which I would steer you towards on the blog, you'll see that I present an argument for our energy sector and generally oil stocks throughout the world to rally in the new year. So you may not see anything for a few months, but I do actually like energy because of this giant support level that it's coming into right now, and also because of the fundamentals. So read my blogs. There's strategic petroleum reserves that need to be filled, plus there's politics involved. So plus there's wars, and all of these things spell out that energy could have a a revival in the new year or sometime after the election, okay? But energy, which is 14% of the TSX, is a non-performing sector. Now let's look at the financials. Now this is the iShares Financial ETF, and it includes both banks and insurance companies, okay? So it includes all of the financials, in fact, anything that is involved in that industry. So what you can see here is a nice breakout out of kind of a little bit of a base down there, and it took out the highs there, which did cause some resistance, but bang, look at the move on that market. All right, interest rates have been falling in Canada. The finance ministers had to push rates down because, as you know, we have been underperforming basically everybody in the world financially because of our rather spendy, non-GDP friendly government. So what we've got is a bit of a recession possibility on our hands in Canada. So the finance minister has been fighting that through lowering rates very aggressively, much more aggressively than in the United States. So we are starting to see, for example, the financials benefit, and you can see the momentum is there. Now they're a bit overbought, and that doesn't surprise you, right? You can see on RSI it's overbought, but when you see all these white candles at that angle, it's overbought. And if you were to look at current prices on this index ETF, 56 versus the 200-day at 40, that's quite high from a momentum perspective. I don't like to see much more than 15% ahead of a moving average, and this is well over that. This is probably somewhere around 30% over the 200-day moving average. So that's telling us that probably the sector will pull back, but overall can't argue with this chart, and that has been a major factor in pushing the TSX up because it's 28% of the index. Now the second last sector we'll look at is materials, which, as you know, I like. I was buying materials and recommending them, when they were trading in here, and they've moved up. They're at a resistance point right now. If we look at momentum, it's kind of flat, so it's not really overbought, it's just flat, okay? So I still like materials, and I think despite any near-term pullbacks, I think what we're going to see is, because of the pressure coming from China, and China is a major user of materials, this is good news for the materials sector. I think that this will break out. If you look at old resistance, materials did break out, but it does kind of need to take out this high of 22. That's going to be a fairly minor resistance point. It'll probably break out, but in the meantime, new positions might be avoided if you hadn't already taken a position, which I've been talking about, as I said, for a year. So keep that sector in mind. Final sector to look at is in industrials. It represents about 12% of the index. So it's not the biggest sector. The more important sectors to look at are financials, which have been doing all the lifting, materials, and energy. So what we're looking at now is the industrials. You see a small breakout after a bit of a cluster through much of this year, coming off of an oversold position, probably from a money flow momentum. It's starting to pick up after being in the dog's house for a while. I would say MACD, same thing, kind of flat, maybe trying to move up. It's really early though, and same with RSI, just sort of meandering along. Is this breakout legit? Right here, if we look at a short-term view, and I'm even going to pull up a daily chart just to get a better perspective. As you can see, this is pretty thin, but it's probably pretty new. I'm going to go back to the weekly just because it's easier to see, but you can see that this is a pretty meager breakout, let's call it that. So I would want to give this some time before I bought into the industrial section in Canada. And this is one of the few, the reason I chose the Bank of Montreal industrials ETF is because it's a pure Canadian industrials ETF. It doesn't hold any global or US industrials in it. So it's really taking a look at how this affects the Canadian index more than anything. And as you can see, the breakout is kind of weak. So what have we got? We've got a general chart of the TSX that looks pretty favorable. Okay, that much we can say for sure. But That's really been driven largely by the financials, and that's been driven by falling interest rates. The financials are, without question, momentarily overbought. I would, suggest that new buyers would maybe invest in banks or avoid the banks, I should say, and the insurance companies for a very short period of time, because there's very likely pullback. That pullback will be an opportunity because you can't argue with that chart. Same thing with materials. I think it looks pretty good for that potential breakout that we just talked about. Industrials, we'll have to see. Like I said, they look a little questionable. And the only sector that is going to take some time, I think, that's influential on the TSX is the energy sector, but I am bullish on energy. So all in, I think these top sectors, which represent 70% of the index, will motivate and push the TSX higher, even if there is strong reason for a short-term pullback on the TSX. In fact, I'm recording this on the 3rd of October, and by the time you see this video, I wouldn't be surprised if some sort of a short-term pullback has already started. Whatever the case, I'm bullish TSX, and I'm bullish the S&P as well, but I do think the TSX may be in for a period of outperformance based on these materials and other sectors that we were just looking at. So thanks for watching, and we'll see you next week.